You invest in ETFs because you heard they're the safest and cheapest way to build wealth? What if I told you that this belief might be making you lose money without even realizing it? Many investors think that all ETFs are the same, that their fees are insignificant, and that they always deliver good returns in the long run. But the truth is that there are hidden pitfalls that can erode your profits and compromise your investments. Today, I'm going to reveal the 5 biggest myths about ETFs that are preventing you from maximizing your gains. If you want to protect your money and avoid mistakes that could cost you tens of thousands of dollars, stay with me until the end, because what you're about to discover could completely change your investment strategy. If you already invest or think about investing in ETFs, this video could save you from mistakes that may cost you tens of thousands of dollars over the years. So go ahead and hit the like button on this video, because this information can help many people avoid market traps. And if you're not yet subscribed to the channel, subscribe now and turn on the notification bell, because here I bring the best content on investments to protect and grow your money. Before diving into the myths, let's get one thing straight. ETFs are an amazing tool for investors. They allow diversification at a relatively low cost and can be a great alternative for those who want to avoid the complexity of choosing individual stocks. But here's the problem. Many people believe that all ETFs are good, that all are cheap, and that you just need to invest and forget about them. And it's precisely because of these misconceptions that many investors lose money. So let's jump straight into the first myth, which is one of the most dangerous and misleading. Many people think that all ETFs are cheap because they are marketed as a low-cost alternative to investing in the financial markets. But the reality is quite different. There are ETFs with extremely low management fees, like 0.03% per year, and there are ETFs that charge over 1% per year. It may seem like a small difference, but in the long run, this gap can cost you thousands of dollars in lost returns. To give you an idea, imagine you invest $100,000 in an ETF with a 1% annual fee. Over 20 years, assuming an average return of 8% per year just in fees, you would have lost over $50,000. And that's not even considering hidden costs, like the bid-ask spread, which many investors ignore. So, if you want to invest smartly, always check the ETF's fees before investing. By the way, if this information is already helping you, take a second to hit the like button. This tells YouTube that this content is valuable and helps more people learn how to invest safely. The second myth that many blindly believe is that every ETF is automatically diversified. It makes sense in theory since ETFs are funds that track indexes, right? But diversification isn't always real. Many ETFs seem diversified, but are actually highly concentrated in just a few assets. Want an example? The famous S&P 500 ETF, which invests in the 500 largest companies in the United States. It looks like excellent diversification. But did you know that more than 20% of this fund is concentrated in just 5 companies? Apple, Microsoft, Amazon, Nvidia, and Google dominate the index. This means that if these companies drop, the entire ETF suffers. And the situation gets worse when we talk about sector ETFs, which invest in just one segment of the economy. During crises, entire sectors can collapse. And if you're invested in a poorly diversified ETF, your losses can be catastrophic. That's why you can't just buy any ETF and assume you're safe. You need to analyze the fund's composition to ensure it truly diversifies your portfolio. And if you haven't subscribed to the channel yet, take a moment to do that now. This way, you'll receive more content that will help you invest wisely and avoid mistakes that could harm your wealth. The third myth is one of the most dangerous, believing that ETFs always track the market. This should be true since they replicate indexes, right? But in practice, many ETFs fail to follow the market as expected. This happens due to 2 main reasons: tracking error and low liquidity. Tracking error is the difference between the ETF's performance and the index it's supposed to replicate. Often, due to internal costs, difficulties in asset allocation and fees, the ETF ends up underperforming compared to expectations. This means that even if the index rises, your ETF might rise less, reducing your returns. Another serious issue is liquidity. Some ETFs have low trading volume, meaning you may struggle to sell your shares at a fair price. If you need to sell quickly, You might end up losing money due to the bid-ask spread. That's why you should always check an ETF's liquidity and tracking error history before investing. This can save you a lot of headaches in the future. And if this tip was useful to you, leave a comment below and tell me which of these myths you once believed. I want to know how many people have fallen into this trap. Now, let's talk about a mistake that many people make. Thinking that ETFs are passive investments that don't require analysis. Many people buy ETFs without understanding what's inside them, just because someone said it was a good investment. This is a huge mistake. There are hundreds of different ETFs with different objectives and strategies. Some track indexes, others use leverage, some focus on dividends, while others specialize in technology. If you blindly buy an ETF without analyzing it, you might be putting your money into an asset that doesn't align with your investor profile. A classic example is emerging market ETFs. Many investors buy them thinking they're diversifying globally, but forget to analyze the countries that make up these funds. Some ETFs are highly exposed to unstable economies, which can increase investment risks. That's why, before buying any ETF, study its composition and understand its objectives. If you do this, you'll already be ahead of 90% of investors. Now we come to the most dangerous myth of all, thinking that every ETF is a good long-term investment. The truth is that many ETFs simply disappear over time. Some are shut down, while others perform so poorly that investors abandon them. There have been cases of ETFs losing more than 80% of their value in just a few years, simply because they focus on sectors that went into decline. An ETF may seem promising today, but if it lacks a solid foundation, it can turn into a disaster in the future. ETFs always guarantee efficient diversification. Not all ETFs offer the diversification they promise. Many investors believe that buying an ETF automatically reduces risk by spreading capital across multiple companies. However, some ETFs are heavily concentrated in specific sectors, geographic regions, or a few dominant companies. This can create a risk similar to buying only a limited set of stocks without the expected safety. It is crucial to analyze the fund's composition before investing. Investors are often attracted to ETFs with low management fees, believing that paying less is always advantageous. However, some of these options have low liquidity, low return predictability, or poor management methodologies. Additionally, hidden costs, such as trading spreads and tracking errors, can negatively impact performance. The idea that all ETFs merely follow indexes mechanically is incorrect. There are actively managed ETFs that function similarly to traditional investment funds. These funds aim to outperform benchmarks, meaning their strategies and risks can be very different from passive ETFs. Understanding this difference helps avoid unpleasant surprises in investment performance. Many investors enter the ETF market expecting to receive regular dividends, but not all funds distribute these earnings directly. Some ETFs reinvest dividends within the fund instead of passing them on to shareholders. For those seeking passive income, it is essential to check this feature before investing. The belief that all ETFs are less volatile than individual stocks is a common mistake. There are ETFs focused on specific sectors, emerging markets, and commodities that can experience very sharp fluctuations. Conservative investors should evaluate the ETF's historical volatility before adding it to their portfolio. While ETFs offer advantages like liquidity and transparency, traditional investment funds may have more well-crafted strategies and greater protection against crises. Depending on the investor's profile, a managed fund might be a better option. Since ETFs are often passive, some believe they are not affected by poor decision-making. However, fund managers still need to make critical decisions, such as portfolio rebalancing and methodology changes. Errors in this process can compromise returns. Although ETFs can be great diversification tools, that doesn't mean every ETF is suitable for beginners. There are leveraged ETFs, derivative ETFs, and highly speculative sector ETFs that can be harmful to inexperienced investors. The tracking error factor. Tracking error is a little discussed but extremely important factor. Many ETFs struggle to replicate their benchmark indexes precisely, leading to unexpected performance differences. Investors need to assess an ETF's replication efficiency before allocating capital. Not every ETF is suitable for short-, medium-, and long-term investments. Some have strategies that work better within specific time frames, and investing without proper planning can result in lower than expected returns. Jake Miller, a 24-year-old from Texas, had always been interested in investing, but didn't want to take unnecessary risks. Fresh out of business school, he heard about ETFs as a safe way to build wealth over time. Instead of blindly believing that all ETFs were safe and profitable, Jake decided to study the topic in depth to understand how different ETFs worked. Jake's first major decision was choosing an ETF that aligned with his financial goals. Many of his friends blindly invested in popular ETFs without analyzing fees or fund composition. However, Jake avoided this mistake by studying each ETF's prospectus and reviewing factors like management fees and liquidity. He realized that some cheap options had hidden costs, so he chose a fund with consistent history of growth. During his first year of investing, Jake saw many people around him investing in thematic ETFs without proper analysis. Some colleagues went all in on trendy sectors like green technology and cryptocurrencies. However, Jake avoided this myth by focusing on well-diversified and balanced ETFs that follow broad indexes with low volatility. When the market corrected and many lost money, Jake's portfolio remained stable. Another common myth among investors was believing that buying an ETF once was enough. Jake avoided this mistake by regularly monitoring and rebalancing his portfolio. Over time, he noticed that some sectors grew too much while others shrank in importance. By adjusting his allocations periodically, he ensured that his investments remained aligned with his long-term strategy. Jake also avoided the mistake of trying to time the market. Many believed they could buy and sell ETFs at the perfect moment to maximize profits, but he knew that consistency was more important. Instead of chasing quick gains, he adopted a strategy of monthly contributions, staying committed regardless of market fluctuations. This discipline allowed his investments to grow steadily over the years. By the time Jake turned 30, he had already accumulated significant wealth thanks to his well-planned strategy. While many of his friends were still trying to recover losses or chasing the next big opportunity, he was reaping the rewards of a safe and well-structured investment approach. His story served as an inspiration for new investors, proving that avoiding myths and investing with knowledge is the key to financial success. So, if you want to invest in ETFs wisely, choose funds with strong fundamentals and a solid performance history. Don't fall into the trap of investing in any ETF just because it seems like a good idea at the moment. If this content helped you see ETFs differently, hit the like button and share this video with someone who needs to hear these truths. And subscribe to the channel now so you don't miss the next videos. Because in the next one, I'll show you how to choose the right ETF for your investor profile. See you there.